Welcome to the Daily Update. This is being prepared Wednesday, May 18th, where we'll look at the action in the market today and then see how things look for Thursday, May 19th. Okay, so if you take everything that happened on Tuesday that was positive, double it, and then go down from there, that's pretty much what happened on Wednesday. It was a really solid down day. The technical picture that had been improving, that's pretty much gone now. And we're not necessarily even oversold, even on a short-term basis yet. Yes, there's a few indicators that could suggest that we're oversold. The bounce that we saw on Tuesday took us out of an oversold condition, and even with the decline on Wednesday, it wasn't that far extreme. Yeah, you could say some of the charts that I'll show you are extreme negative. Intermediate term, we're not. Now, we are still really extreme as far as sentiment. There is a tremendous amount of fear, but so far, the fear is being justified. We want to use fear as a contrary indicator so that when everybody's looking to get out, that's when we're looking to get in. It looked like things were getting a lot more positive after Tuesday. Well, that was just about wiped out. So let's go back and talk about what in the world happened on Wednesday. Right at the open, we did have a gap lower, and we gapped right down to S1 at 40.52. Then it didn't take very long for us to fall down to S2, which was at 40.14, right out of the gate. As the day went on, we saw more selling, which then ended up taking prices below 4,000, and then eventually we fell below S3, which you usually don't see on the chart very often. That was at 39.65. Going into the close, we just saw prices falling and falling, and we ended up being down 4.04%. Volume was above average. Things really picked up that way. The technicals have now switched back to decidedly negative. Inflation and growth concerns and interest rates and profit margins and all those things, that's what the market is more fixated on right now. They're just worried that prices can't necessarily keep up with inflation. If we raise prices to the products and services that we're selling, people are going to get to the point where they can't afford them anymore, and that will really decrease demand, and that could really hurt our bottom line. Of course, we have the geopolitical concerns. Not only is Finland going to go ahead and join NATO, but Sweden is going to join also. And then earnings reports that are coming out. Sometimes they're positive, sometimes they are negative. So what are some comments that we can make? The S&P is below 4,000 now. Another thing that's interesting is the 10 to the 5 yield. It's gone inverted again. This may not be a major player. It's not necessarily predicting a recession, but we played with this a week or a week and a half ago. Well, now it's gone back inverted again, where you're getting a higher yield on the 5-year than you are on the 10-year. And that's just not the way it's supposed to work. The long-term support was lost at 40.61, which is way in the rearview mirror now. Interest rates and stocks both declined together. And I have kind of an interesting chart to show you later on of how tech and interest rates are relating to each other. The China lockdowns may be easing, which could be positive, since that might help their economy get going again and they can start producing things that Americans like to buy. The technicals that were improving, that's gone. Fear is still very extreme and even more extreme than it was yesterday. We're still in correction territory. We're not quite in bear market territory yet. We'll have to see. Last week, we got right down to that bear market level and we saw some real buying come in. Is that going to hold if prices end up falling down to that level again? The economic reports that came out, housing starts declined. We're seeing some slowdown. Building permits decreased. More slowdown. The weekly mortgage applications index, it declined 11%, where last week it was up 2%. So the market doesn't really like these things. Our trend is negative and getting stronger because we had a down day. The bias, since we had a down day, is negative. The momentum, for the most part, the last 2, 3, 4, 5 days have been negative as well. Let's go through the day's session. First of all, we'll look at sentiment, how people are feeling, And we are pretty extreme. We ended up dropping down to 9. And here's the historical chart to give you a reference point over here. Times in the past, we've been able to bounce up out of this. The VIX, which had been declining, and it looked like it was giving off clues that things were less fearful, at least the folks that use the VIX, well, a lot of that fear spiked up, but we're not extreme at this point. Yeah, we did go higher based on a closing basis, and we closed right at or near the top of the bar on the bar chart. So fear did increase, but we've been higher than this before. So there might be some more room to run as far as fear is concerned, according to the VIX. The VIX of the VIX, which just measures how volatile the VIX is, it had been really slowing down. Well, then we saw a real spike up on the bar chart and on a closing basis. The ulcer index, which has pretty much been hanging in there with the fear going up, it declined a little bit last week, but so far for this week, it has been advancing. And it just shows that there is an increase in fear. And here's the longer term look at that to tell you where were we at other times when fear became very extreme. As I pointed out in yesterday's video, we're in different conditions now than we were in 2020 and 2021. So does that mean that fear is going to go a lot higher than it is right now? That could be the case. Equity put call ratio, it did go up, but it didn't spike as much as it did earlier in April. And our 5-period moving average of the equity put call ratio, it turned back up. It's still very, very high overall, but it had been declining after Tuesday. Well, it turned back up after Wednesday. Different sectors. The sector that did the worst were discretionary, down 6.54%. Staples, which have been holding up quite well, they were down 6.43%. Tech, down 4.5%. And none of the sectors ended up being positive. The one that did the least worst were utilities, and they were down 0.97% on the day. So everything pretty much got hit. Here we are looking at the different sectors since the all-time high, where energy, even though it's been getting hit lately, is still performing the best, and then you have utilities after that. All the other sectors are now negative, with discretionary taking up the rear, followed by communication, tech, and financials, and then real estate. Our technical alerts, where we saw all positive ones on Tuesday, well, we started off with some positive ones here, but when they turn red, that means they are considered negative. The list is pretty long. The only one I could pick out for the S&P was that we dropped below 4,000. But a lot of the different sectors, a lot of different things that we're looking at going more positive are now switching back and looking more negative. Intraday, way over on the right-hand side, we gapped down to S1 and then just kept going all the way down to S2. Then we eventually just kept going all the way down to S3. We tried to build up a little bit of support right here. I actually had to draw this line on here. This software, it's supposed to draw S3, but it didn't. So I ended up putting this line in here. Well, that didn't last all that long, and we ended up dropping below and just sell. We came up a little bit off the lows going into the close, but by then, my goodness. Looking at our daily chart, here I have where we're at right now highlighted. We were able to get back above the long-term support yesterday. We fell right back down, and we actually came down below S1, and this is just kind of dangling right now. We have not exceeded the low set last week. This is the bear market territory that we really want to watch for. Is the market going to be able to bounce up from here, or is it going to continue to fall? Looking down at volume on the bottom, we did see an increase, and it was above average on a down day. Here's just a machine gun looking chart where we're down below the long-term support. We're coming down. We're in danger of getting to the 50% retracement measured off of the all-time high, going back to a significant low. These different levels in here are just possible areas of support that we want to look at, with this 50% and this S2 being pretty significant. We're down 18.2%, so we're 1.8% away from being in bear market territory. from the all-time high. Technical overview. Nothing has changed here. Energy, commodities, gold, interest rates, and staples, even though staples are starting to get whacked a bit, they are still positive either in and of themselves or on a relative basis. Looking at those things that are negative, it's the same list that we've been doing now for a number of days. Different indexes, different sectors, even different markets are pretty much negative overall. You've got things like ARK, which had a really difficult day. Bitcoin's down below 30. Bond prices, even though they bounced a little bit, still have a long way to go to turn back positive. So let's look at our trend. Here's the ADX. We saw a real spike up with the red line, and the red line is negative. So we're seeing the ADX getting a bit stronger, and we're seeing a decrease in buying power. So our trend is in place, and it is negative. The Arun, which again was showing some improvement, it's still showing a little bit of a decrease on selling because it's picking up where we were last week. So it's like, I'm not seeing anything new here. I'm going to go ahead and just stay the same. Well, it also picked up a little bit of a decrease in selling, but overall we were flat from Tuesday to Wednesday. Looking at breadth, after we saw a couple of good solid up days, we didn't see that on Wednesday. We saw a solid down day. We saw a real decline based on price and based on volume. The highs and the lows, not necessarily extreme, they're negative, but we're at a minus 27 right now, so this could still go lower after going extreme and looking like things were getting better. The 10-day average, we were pretty extreme, even though we could have gone lower, trying to bounce up from this. It's not quite as bad, but we were hoping that this chart would improve if things were going to turn back more positive, and it just hasn't all that much. The advanced decline line ratio, it did try to bounce up, and that was looking okay. Well, we came back down. New highs and new lows, they were giving us some hope, and they were kind of telling us early that things might be changing, and it's still positive. We're still above the moving average overall, but this is not a very healthy sign, and this could easily turn back down, or our 10-day differential is also declining now where it had been going up. Accumulation distribution, we were above the moving average on Tuesday. We're back below it now after Wednesday. Short-term McClellan oscillator was positive. Now it's back negative. Force index was improving, but is now more negative and not necessarily extreme. Stochc RSI, one of our more touchy indicators, was really starting to show some improvement. No, now it's negative. Williams percent R, same thing, looking better, but now you could say a little bit extreme negative, but this indicator can go down and just camp here if we keep going down. Our moving average study was really showing some improvement. Nope. 50 period, nope. 200, nope. Taken off the table. Stochastics also were showing some improvement. Short term, no. Intermediate term, no. Long term, never did really get positive. But we were hoping, if you're more bullish on the market, that this would have been improving, but now it's going to take a lot more than what has happened. On a one-day basis, looking at the advanced decline ratio, we really shot up. I had this chart yesterday because we were extreme positive. Now we're way down to being extreme negative. So maybe on a one-day basis, we kind of overdid it. Intermediate term, rate of change 1, poof. Pegged negative after being pegged positive. Rate of change looking back 10 periods was trying to improve. Nope. Now it's extreme negative. Looking back 20 periods, extreme negative. Standard deviation, we're getting back down closer to the mean price. We had been a little higher above, so it just shows that we're starting to chop around a lot. Momentum oscillators, the slope is still trying to eke out a positive signal here. The MACD tried to turn up, but then stalled. The KST and TRIX continue to decline, PMO and TSI. TSI was trying to cross over, but no, that just wasn't happening yet. Vortex, increase based on selling, decrease based on buying. The red line is on top, so we are negative. Sean Trend Meter, extreme negative. The Swinland Trading Oscillator. This one is kind of going a little against what's happening here, but lately this has been kind of a good leading indicator. We actually saw a bit of an advance based on price and volume, but that's kind of an outlier compared to the other things that we're seeing right now. BPI was coming up out of an oversold condition. Well, now it's dropping back down. PMO was trying to turn up, but is negative. And also when you measure it based on price and volume, both continue to be negative. The PMOs that were rising, it was starting to get pretty positive, but has since declined. The buy signals have also declined, and we're flat to slightly lower with those PMOs that are above zero. Summation index is kind of bouncing around right now. This little signal that we saw based on volume, which sometimes can be a leading indicator, it was a false signal. We just have to be aware of that at times. The boom indicator, after showing some improvement, this is how far we're away from the 20-period moving average, because the price and the moving average act like magnets or rubber bands to pull it back. Well, it's now more extreme negative, and we saw a little bit of improvement with the 200. Well, we're right back down to where we were after Monday. Chaikin Oscillator was also going positive, but then has now rolled over. Ease of movement was showing a lot of improvement, but is now declining. TTM squeeze looked like we were trying to get it back above this anchored moving average here, but we've now fallen back below it. And it just shows that it's trying to show some improvement here, but if we see some more follow through, this is going to keep going down. And here in our oscillator basis, just showing that we're pretty extreme negative, but we're not necessarily extreme as we have been before in the short term. We still have more room to fall if the market continues to decline. Balance of power. It had been going positive, has now switched back to negative. The Connors RSI was showing us some improvement. Now it's negative. The different charts. The Heiken Ashi was looking better. Not now. The Kegi, which never did turn positive, it remains negative, as does the Renko. The 3-line break just continues to add these black candles here, and that's not positive. Different trading systems. The Elder system, which had switched back to positive, is now negative. Same thing with the SPY. The SAR, which always remained negative, it continues to be negative. Our purple rain is getting darker here with the go, no-go system. It had switched back to more of a neutral stance. Nope, not after today's action. Long term, we're below the 200-day moving average. The rate of change going back 200 periods, starting to get a bit extreme negative. Our moving average study, which was really showing some improvements. No, not now. Not with the 50, not with the 150, not with the 200. Special K, this never did turn up and is still decidedly negative. That's our longer term trend measure tool. Long term, the diamonds have now switched back to negative after being neutral, and the Qs have switched back to being negative after being neutral. The Vixen, it spiked up. That's the VIX on the NASDAQ 100, but it could go higher than this. And on a closing basis, it also saw a real rise, but we've been higher than this before. Looking at the broad market with the Amex, the NASDAQ, and the NYSE, the 5-period moving average between the highs and the lows, we had gone extreme negative, and it is showing some improvement, but we really didn't show much more after Wednesday. Broad market, the dollar, it was actually up. It had really fallen on Tuesday. It bounced back up 0.44% on Wednesday. Oil, it declined, but it's still very high at 107.04. Gold futures, we're down a little bit, and we're still below the 200-day moving average. And here's the gold ETF, where it was up 0.05%, but is still below these moving averages. The longer it stays here, the more chance we might see a death cross in the future. And here's a long-term look at the gold ETF. Silver ended up being down 0.95%. We're in danger of seeing a death cross here too. It's really run into some difficult times, and here's the longer term chart. Bitcoin just remains below 30 for right now. It's just kind of bouncing around, and you go into some of the chat rooms and some people are euphoric because they're like, I told you so, it's garbage. And other people are like, I've lost my life savings. Buy it now at 100K by December. It's kind of interesting to watch that stuff. But the reason for bringing this up is really just because this is textbook head and shoulders formations. And this text that I have right here, that was put up over a year ago when I posted a video. And just to suggest that if we really fall below this level, things could get ugly. The market is really trying to figure out, is it going to go down from here? Because it knows how ugly things could get. Bonds actually bounced up a little bit based on price, but are still in an overall downtrend. The 30-year yield from the high set back in 2007 to the low in 2020, we have still flirted with the 50% retracement, even though we're a little bit below that. Then I wanted to bring this chart up just because the 10 to the 5, which is not necessarily a huge yield curve for us, but it did go inverted, and that's not the way things usually work. And here's an isolated chart just showing that we're at minus 0.01 right now. Treasury yields, you can see the 10 and the 5 are kissing over here. We did see a decline in the longer term rates as well as in the shorter term rates. So that's interesting. Stocks are going down, interest rates going down together. We're watching Japan right here. Not much of a real change. And this is a weekly chart, so this doesn't really change all that much. It updates every day, but it could look different from day to day because it's assuming today is Friday. Then Japanese yen bounced a little bit. The euro bounced a little bit, but the dollar has still been having a nice solid uptrend lately when you compare the two with each other. Here is the euro, which is at 104.64. The dollar's at 103.86. So the euro is still slightly ahead of the dollar right now. Then this is the chart I wanted to bring up. I was showing this chart a few weeks ago when we were way down here, back in the middle of April, showing that if interest rates were going up, techs were going down. Well, now we're seeing almost the exact opposite. It's like they're moving in the same direction with each other. When this gets to -1, that means that's an inverse relationship. When they get closer to +1, that means they're going lockstep together. And if you look up here, the tech sector is the black line, which has really been having trouble, and the dotted red line is the 10-year yield. Our possible positive scenarios are not looking very positive right now. We did see the Copic curve try to cross over. Well, now it's flopping. The 2-year treasury. Have we topped out? We don't really know. When this spikes and then starts to fall, that sometimes marks a really strong short-term upthrust in the S&P. The mass index has not generated the second part of its signal yet. We did when we went above 27. Now we're seeing, can we drop below 26.5? That has not happened. Bottom Fisher is trying to turn up, but has not crossed yet. This is looking a little bit more viable. You see how we've come down with the staples? When you compare the ratio of the staples to the S&P with the S&P itself, when this spikes up and then goes down, that has marked a significant bottom in the S&P. The problem is we don't really know if that's happening. We were looking at it when we were down here thinking, has it spiked? Has it spiked? Well, now, has it spiked? Has it spiked? And this little blue dot, that's where we're at right now. We want to keep an eye on this, but we need to see confirmation from other indicators. The small cap ratio, sometimes we see a little thrust up. Even though it was up over 0.5% on a comparative basis, we need to see this go up higher than that. And then sometimes a few days after that, we'll see the blue line, which is the S&P. It will start to go up after that. We don't really see that happening yet. We saw it back in the middle of March, but we're not seeing it now. So what's our outlook then? The technicals, those things that were improving are pretty much gone now. The markets are still below the intermediate term range, and they lost the long-term support that we had regained. Value did less worse on Wednesday. Nothing won on Wednesday. Growth did really bad. Value did bad, but not as bad. Economic reports that are coming out on Thursday. We have jobless claims, which come out every week. Then we have existing home sales, and then the Philadelphia Fed Index, and another thing called the LEI, the leading economic indicator. Geopolitical events, Russia, Ukraine, anything could happen positive or negative in that area. The supply chain issue might be getting a little bit better because they may stop with the lockdowns in China. Inflation and interest rates, that's the real fixation right now. We want to keep an eye on oil, earnings as they come out. If anybody in the Fed says something, that can make the markets go up or down. And then the longer term scenario we're looking at with Japan. Looking at our scenarios, down, and that's why this is highlighted. This is the scenario that we're playing with right now that is negative. What's causing things to be negative? Interest rates and inflation fears. And I have this question mark here because we've been seeing interest rates go in the same direction as stocks for the last week and a half. Earnings, Fed speak that comes out that could drive the market slower. The technicals are negative. And so the path of least resistance right now is down. But as with anything, it's possible for the market to do whatever it wants and defy any kind of logic whatsoever. What can we see that might make the markets turn more positive? We've got to see improving technicals, and they're not improving right now. They were, but now they're getting kind of weak again. The one thing that could be potentially positive is that we have negative sentiment right now, and it is extreme. Everybody's predicting the end of the world as far as the stock market is concerned. That's when we want to start thinking the other way. Our possible positive scenarios, none of them are really in play right now, except maybe the Staples spike. That could be happening, but we need to see that play out. Technicals, pivots, and previous levels may provide support. The fact that we fell through 4,000 was very negative. There's some other support levels below where we're at right now. There's the bear market invisible fence. If we end up going down lower from that, if prices continue to go higher, we're probably going to hit some pretty significant resistance quickly. And then sideways, that's not really a viable scenario right now because the ADX is above 20 and it's giving us a negative trend. So our conclusion is that the S&P is negative. Short term, it's negative, and I say slightly oversold. You see the few indicators that I went through? But there's other ones that are a little bit more helpful for us determining an oversold condition, and those aren't necessarily oversold right now. Intermediate term, it's just flat out negative right now. The oscillators are negative, and we're below all the moving averages. Long term, we're negative because we continue to be below the 200-day simple moving average. So thank you very much. I hope that you have a very good day, and may the trend be forever in your favor.